Good morning, November 22nd, 2019. A lot of ground to cover. Going to work with ETF asset allocation, look at the market in general, cover a bunch of stocks, and start with an article that should be on the free website that's Seeking Alpha soon. Does not give a lot of recommendations, but talks more about the general dynamics of the oil market, looking short, intermediate, and long term. And my realization, even having been very aggressive and believing that oil would disappear as a primary transportation fuel quicker than most, it's happening even faster. And this week's release of the Ford Mustang Mach-E has me even more convinced that gasoline-powered cars are going to go the way of the dinosaur much, much faster than people think. So let's cover the bullet points here. Oil demand growth is flattening rapidly. We already know that. Peak oil demand is likely to happen in the next 5 to 10 years. Cost competitive oil supply is becoming more scarce. Oil prices are likely to rise in the intermediate term, but may not do much in the short term. And higher oil prices will spur the adoption of EVs and alternative energy. So I introduced this chart a couple of years ago where I showed that oil demand would peak at around 105 million barrels per day, be level for about 5, 6, 7 years, and then start to fall off rapidly in the 2030s. By 2050, be using half as much oil. And I think that this may not even be steep enough. We might be using 20 to 30 million barrels a day by 2050, but depending on how quickly plastic alternatives come online with the wiping out of a lot of the petrochemical business, we'll see. Also, I'm not positive that electric airplanes will ever really be a thing, even though they are moving to much more efficient models if they can get the software to work properly. And that would be a shot at Boeing. So here are, this is from BP, I believe, estimates of oil demand. And you'll see that the sustainable development goals of the international community would show a similar curve that I've shown, where oil demand is going to peak imminently and then start to turn over. Interestingly, BP, look at their lines, they're the least aggressive. They believe that oil demand is peaking right now as well. Wood Mackenzie just sees it going up at a slower pace, but not quite peaking. OPEC has revised their projections down. They had oil demand in 2040 being way over here, way up here. They were very aggressive about 5 years ago, and that has come down dramatically. The EIA and IEA are more aggressive based on current policy. The EIA is very aggressive. And then PIRA, I don't even know who they are. Petroleum Institute of something. Citigroup, which called the shale boom about a month after I did, basically doesn't want to say what they think is going to happen past about 2025. But as you can see, these estimates have all come way down from being up at 130, 140 million barrels a day by 2040. They're all flattening out their estimates. And I think that they're probably still not conservative, not aggressive enough on that. If you take a look at some of the new supply required to use the oil, to get the oil that we need, what you'll see is that if demand holds steady around 100-ish million barrels a day, this is the demand decline, or the decline in oil production without new investment. And we know that new investment's been falling. So this area in here is the gap that still has to be filled. And right now, about half of it is filled. So from about here to about here, we still have to invest that money. The same is true with natural gas, which is also showing decline in output, right? That's natural decline, 3, 4, 5, 6% per year, depending on, which well you're at. And this is money that's needed to keep the supply up there with demand. And again, remember, we're seeing demand still go up just a little bit, 1% a year, maybe 2. But investment in the sector is not growing that fast anymore as of the last year. The sustainable development case is what I think is actually the base case. I think that you see a little bit more increase in demand to around 105 million barrels a day. And I made this as consistent with my other chart as possible. Just using tools. So we'll get those 4, 5, 6, 7 years of flatness, and then it's going to turn over rapidly. So while I see demand going higher than the IEA Sustainable Development Case, which is a couple years old now, right? Demand is already up here. It'll turn over quicker. And ultimately, this curve gets steeper and steeper and steeper. So I think that's something for us to be aware of. In the very short term, you have the Saudi Arabians and the Russians in the last week basically saying that there won't be any new cuts in production, but they're going to hold the cuts probably through next year, for sure through March. And we will see what happens in spring. I think it's very likely that you start to see a little extra oil put out by Saudi Arabia starting next summer. And that's for a couple of reasons. The first one is I believe that they are basically beholden a little bit to President Trump because he's protecting them right now. The troops from Syria moved to Iran and Iraq. They didn't come home. And that is something that Syria needs because the conflict with Iran is simmering hot right now. Anybody who doesn't think that that is a real on the brink of war situation just doesn't really pay attention. They've already fired missiles over there. Iran has already fired missiles at Syria. They've tried to blow up each other's infrastructure and a couple of tankers. So we'll see if that conflict ever does erupt. I've been saying for a few years that it was likely, but it hasn't happened. So the only real thing that I see raising oil prices next year more than $5 or $10 a barrel is that there would be some sort of conflict in the Middle East. Other than that, you have enough domestic production, at least now, and enough oil waiting from Saudi Arabia that the odds of oil getting much over $60 to $70 a barrel are pretty slim. At the same time, I don't see a crash coming either unless the economy just heads into the tank. As I've said, I don't think we're in for a big recession. I think we get a little bit of a slowdown, maybe what I've deemed a skip straight recession, where we do have maybe one barely negative quarter. But again, that is dependent on if China wants to put pressure on President Trump. We don't know that they want to or they don't want to. I suspect, as I've always suspected, and as I've said on this webinar, they just want what they want. So they'll do whatever they have to do to get what they want. I don't really think they care too much about American domestic politics. I really don't. I don't think they like President Trump, but I think they know that with the exception of Joe Biden and a couple of other unlikely to get nominated Democrats, Elizabeth Warren, Bernie Sanders, you know, they're going to be tough on China too. So we'll see what could happen. Somebody just asked the question, if there was a war with Iran, could Iran massively damage Saudi's oil infrastructure? Yes. I don't even think it would be that difficult for them. They've already done it once, sort of as a shot across the bow. Would they? Well, here's a better question. Why wouldn't they? If they're going to bother to go to war with Saudi Arabia and they want to see oil prices go up, put pressure on everybody else to intervene so that they can sell their oil again, why wouldn't they? So if there's a conflict between Iran and Saudi Arabia, yeah, I think I've always said, I think oil infrastructure is a major target. I think that the attacks that have already occurred proves that. So we'll see what happens. Why wasn't there retaliation for the missile attack on Saudi Arabia? Well, actually, there was. There was two minor retaliatory strikes, one on a ship, one on, I believe it was some sort of piping, some sort of midstream. I don't remember what it was. So could they massively disrupt oil supply? Yeah. I mean, you could see 7, 8, 9, 10 million barrels a day off the market if they drag Iraq into it. So, you know, we'll see if Iran decides that they want to do that. I'm not very confident in the United States back channel diplomacy right now with Iran. So I think anybody trying to predict what's going to happen there at this point, you know, I think that they probably need to take a step back because I don't think it's terribly predictable. Israel is a wild card there. You know, Netanyahu would love to have a war with Iran, and I think that if something gets sparked, he could definitely be part of it. We'll see. I don't know that Saudi Arabia feels as if they can have a war with Iran and not lose a lot of money. So we'll see. But keep in mind that this Aramco IPO, which isn't going to raise that much money, does free Saudi Arabia up a little bit to be more aggressive. Why? Because they're getting front loaded on that payment. So we'll see how that goes. The Saudi Aramco IPO is interesting in that it's smaller than expected and very domestic. They're basically getting the billionaires in Saudi Arabia to, you know, buy the company. And in the short term, that's probably not great for them. But in the long term, you know, oil goes away, but Saudi Arabia is going to be the last man standing there because they have the most domestic reserves that are conventionally available. You know, even with the oil in America, not much of it is conventionally available anymore. We have to use unconventionals. So we'll see. In any case, I think that this is an important article to read to get a hold of the short term. The survivors, because oil bankruptcies are again rising, came down. This is just so far this year, so they'll exceed 2018. They actually caught up a couple days ago. Next year we could see, you know, maybe not this, but this sort of bankruptcy. And it's very possible Chesapeake goes under next year, unless somebody really comes and gives them a lifeline. The lower for longer has just crushed them. I've always said that they were a binary bet on oil going up. Oil and gas did not go up, right? They're 75, they're 3/4 gas and 1/4 oil. I think the shareholders are probably in trouble there. You know, we got rid of our shares early last year, bought some options with part of that money. We're able to trade out of some of the options at a profit, but any options, any calls that were held on are worthless at this point. So the bottom line is we are at the beginning of the end of the oil age. We're not in batting practice anymore. We're working our way through the first batting order right now. So we're second inning maybe. And that's something that we have to be aware of. So I think there's still great buying opportunities for the surviving companies in the oil patch next year. I think they're about as cheap as they can get, but I've thought that before. We'll see what sentiment is by investors, but the companies that are putting out cash flow, and I mentioned in here that Rystad said that they were able to measure that there's free cash flow over capex now, but that free cash flow over capex is concentrated in about a dozen companies, the dirty dozen oil stocks. So I've nailed which companies are going to be free cash flow for you in the articles that I've written. Now it's just a matter of at what point do they stop going down in price. Your guess is as good as mine. I've thought we've had technical bottoms 3 times. So we're at a 3 standard deviation move right now. Very rarely that it goes beyond that unless companies actually start going out of business. But the money in the ETFs should flow to the remaining companies. So at some point, you got to think these survivors are in great shape. I like Occidental because they're positioning for the future of energy after oil. And if they are able to divest a few assets, even if they don't get much, they just get out from the expenses. I think they're in pretty darn good shape. So let's move to the market more broadly. This is one of the, I have their pro subscription over here at ETF database. Just want to show you the biggest the biggest ETFs out there. QQQ is the one that I always talk about because it's usually the best performer among the diversified ETFs. The big companies out there, we saw the, I don't know if it got announced yesterday or not, if it's final, but Schwab looks like they're buying TD Ameritrade. I think you're going to see more consolidation in the ETF offering space too. So here are your 10 biggest companies, and there's about 36 or 45 or something. There's another big group out there. But these 10 companies control most of the ETF market. And then there's all sorts of niche companies out there. I believe that some of these companies in this list will actually get bought. I think Schwab is a very likely acquirer of a fund family. I think Wisdom Tree is clearly in play. So we might even want to take a look at their stock. I think Wisdom Tree is in play because they have good factor-based ETFs. ProShares, I don't know. Does anybody really even use ProShares anymore other than day traders? Right? And Directions, I think, is right behind these guys. So you'll see more consolidation, probably a little bit more fee compression. But the companies that remain, as we know, as oligopolies develop, that becomes more profitable. So we'll see, where the crossover lines are with how this goes. Can Invesco keep adding assets while they're reducing expenses? I think that they're in the sweet spot. I don't think Spider, I just don't see them doing much. I think they just stay there, and quite possibly Invesco or Charles Schwab eventually catches Spider. We'll see. I've been doing these screens on ETFs. So these are diversified ETFs that pay a dividend above the dividend for QQQ. So the dividend for QQQ dropped to below 0.8, which was my old benchmark. So I lowered it a little bit because I want to have QQQ in here as a benchmark. Measured on almost any time frame, you're going to see QQQ on this first page. So 20-day total return, There's been a slight rotation in the value, but that is more driven by, I think, selling in other places. So I don't know that there's really been much of a rotation in the value. I think this is a short-term anomaly. Something to keep in mind is that value usually outperforms at the end of a cycle. So this is not a good sign if this is a real rotation into value. And it could be, because some of these are value-oriented funds. Quite a few of these are value-oriented funds. So if you throw out QQQ and a little pop in Russell here in the last month, which is, they've been taking on the chin for a while. This is more value, more value, more value. I don't know what that is. I'd have to check that one out. But, supposedly value, value. All these large company ones. We'll see. We'll see what that means. Over the last 6 months, I'd be surprised if QQQ is not near the top here. Yeah, QQQ consistently near the top. 3 years. The reason I looked at 6 months is because a lot of rotations happen on roughly 6-month time frames. Has to do with seasonality. QQQ top for 3 years total return. My guess is they're top for 5. Right. This is why QQQ is a core holding. Why am I showing that? Because I started to incorporate the model portfolios. So the Global Trends ETF model portfolio is based on a moderate risk investor. And if you're aggressive or conservative, I give you some guidelines on how to adjust your asset allocation. So right now, I've dumped XOP because you don't have to make your money back where you lost it. And we have 2 clean energy ETFs, the iShares Global Clean Energy, which pays a bit of a dividend, and Invesco, I guess this one pays a little dividend too, solar. And that's been a very good performer. Why are we in Australia? Because they almost never lose because they are selling to Asia. Malaysia is a deep value rebound play, token position. But I think that this could grow. The small cap, low volatility. One thing to know about small caps is that profitable small caps with any kind of growth typically do very, very well. So this has been a very good performing ETF in a space, small caps, that hasn't done well for several years. Why has there been a big shift from small caps outperforming to large cap outperforming? I think the basic answer is the ETFs. People just pile into the ETFs, which are market weighted. So SPY, VU, iShares has one, I think it's called Core 500 or something. And then QQQ and the Dow Jones Industrial Average, everybody's money is going into the large caps. And ultimately, that's fine until you get too big of a spike, right? Until the value disparities are so wide that there has to be the alligator jaws have to close. And we've talked about alligator jaws. So there's a lot of alligator jaws out there right now. At some point, those alligator jaws come closed, and that won't be good for a lot of people. Now, if you're aggressive and you want to try to play the year-end rally, you certainly can bring down your cash level. So at 60% cash, as my base recommendation, if you want to only have 30% cash and remain aggressive with a lot of QQQ and ARC, have at it. Just understand that you need to be quick on the trigger to sell if things start to go south early next year or tomorrow. I have been playing with TradingView for the last couple of months, I actually subscribed to their Pro service, Pro Plus service. It's their second most expensive service. I don't really need the day trading stuff, which is in the most aggressive, their highest price service. So this Pro Plus, I have a discount that I'm going to be able to offer you. So I'll put that into an article. And just looking at the headlines, the ideas from technical traders on QQQ, read these, and what you'll notice is virtually everybody's getting bearish. So if we get that little Thanksgiving hiccup that I've described, these folks will all claim to be right. And some of these folks are very good. I've been starting to follow a number of them. But a lot of them are just people who learned how to draw a picture and they guess what it means. Just go through all these. They're all becoming exhausted, descending. This guy is bullish. So you go through these and you can get a pretty interesting take on sentiment. So last night I was supposed to go to the American Association of Investors meeting here in Milwaukee, and went to Costco instead with a girlfriend. But I've read the guy's stuff. I was going to go because I knew who the guy was. I think that there's a very good possibility this melt up at the end of the year and early next year happens. 4, 5, 6 really good weeks, 7 good weeks. But if you were listening to the news, right, you've heard a lot of the billionaires talking about, well, if Elizabeth Warren's the nominee for the Democrats, this market's going to sell off. And they don't want to say what the real reason is, but it's because they'll lose their tax breaks. So, keep that in mind. Elizabeth Warren is good for America long term, I think, based on having a better regulatory policy. And I think that Congress keeps in line some of the radical stuff that she seems to be running on. I think she's more pragmatic. I think she's just trying to get the nomination. So is she destructive? Nah, I don't think so. I think a better healthcare system is good for America. I think a greener economy is better for America if we become a leader and all that stuff again, which industry is doing a good job of doing it themselves without the government being too involved. So I just think that the real linchpin, with everything else just being noise, is what is tax policy. And if tax policy is tighter on the rich, there will be a short-term correction. If you read a new book, there's a new book out there, and we need to start doing our book club. The Rich Dad, Poor Dad guy, Kiyosaki, whatever his name is. I tweeted out a summary of that book. And basically, he points out that, hey, the rich in general are smart financially. And they also are very good at understanding how crashes work. So they'll generally accumulate cash going into a market topping cycle, and then they're very good at buying when things are cheap. And that's really the simplest way to explain how good investors do things. So you should be accumulating cash. If you haven't got already to the targets that I've set out there, you ought to be working in that direction on the rallies. This is a sell the rip market, not a buy the dip market. I'm going to go through some companies here. I'm going to start with SunPower, since we're kind of on energy. So the stock had this fabulous rally, then started to have a technical correction. Why? Because most of these stocks in the stock market are thinly traded now. We've talked about over and over again how the traders have more and more power. So you throw in over here at the end that they are going to do a spin-off of their international and manufacturing operations. Basically, it's going to be an American company and then an international company. And I think that's good because SunPower gets to focus on the part of the market that I've talked about being what they should do, which is commercial and residential expansion, providing the services, and the energy services. So the engineering and the energy services. So down here, I think that this really has gotten to be pretty attractive. I told you a few months ago it could get down under 7 again. Looks like maybe it does. But if we take a look at RSI, it is super oversold, and it's been that way for over a month now. And the money flow seems to have bottomed out. If we take a look at the weekly money flow, right, it's about as bad as it can get. And we know that the longer term money flow still likes it. So, oh, that's not money flow. How'd that happen? There you go. That makes more sense. Money flow is pretty much bottomed out across the board. There you go. I knew that MACD looked wrong. How'd that get on my chart? I like money flow better than MACD. Although it's nice when you see the lines cross on MACD. That should tell you something. So this is about as bad as it gets, right? I think we're in for an imminent reversal in Sun Power. I think you can sell puts here. I would probably sell $7 puts or $8 puts if you want the position. But I think you can sell $7 puts with an expectation that you probably don't get the stock. You just take the premium. If you do get the stock, you're down probably at a low 6 something cost basis. And I think that that's fine for adding position, then trim it on the way up or sell some covered calls. First Solar got out of the utility business, which is what I thought was going to make them a lot of money. And now they're just a panel manufacturer. Under the current trade regime, they're in pretty good shape. And it looks like they're about to rally as well. Money flow started moving in their direction. Price started to firm up. So unless this turns over again, right, this looks like it's probably going to do pretty well. Again, the short-term stuff is not what I'm too concerned about, though. I'm just showing you that these are probably good entry areas. Although, you know, I have told you mid-40s, it could definitely get down to the mid-40s. So if you're anxious, I think you can nibble. If you're patient, I think you wait to see if it gets into the middle 40s or if you get some opportunities to sell cash secured puts. I'm going to use this. AT&T got beat up a little bit this week. I don't know that it gets down to any lower. That dividend's still pretty fat. This just drifts along, more people becoming interested. A lot of the traders have been looking in the low 40s as a place to get out. So I think some of the traders just got out ahead of time. Maybe had some institutions trim because they probably were overexposed. The daily, the money flow just started to go back up, even though the price came down. So right about here, look at that. You have that one little flat period, price dropped. That's indicative of a big seller to me. So I don't know who did that. And now it's choppy. If you don't own AT&T, I still think that they're going to be in pretty good shape. I was discussing this with somebody else. I think that ultimately, and I think that John Malone pointed this out, I think ultimately AT&T acquires a lot of new wireless users in the next few years. And I think at some point Warner Brothers gets put up for sale. I don't think AT&T owns Warner Brothers forever. And when they sell it, they're going to get an awful lot of money. Natural buyers, Apple. Apple is a natural buyer for Warner Brothers. And AT&T and Apple already have a very good relationship. So we'll see if AT&T stays in the content manufacturing business, which is very capital intensive, who's a company out there with a ton of cash and would love to have the Warner Brothers library to put onto their new streaming service? You could see AT&T just basically sell all of their entertainment and say, look, let's just do what Verizon is doing, and let's flip these assets and make billions and billions of dollars now that we have all these broadband customers. I think it's a very likely scenario. I still think AT&T breaks through the low 40s mark at some point and establishes a new higher trading range. Once they get that big capital infusion from selling off some assets, man, this dividend just looks awesome at that point, doesn't it? So I think you should be looking for dips to buy AT&T. How low can it go? Middle 30s for sure. I don't think it sees 30 again, though. Nutrien has gotten beat up because the farmers have just gotten crushed with bad weather. So they had to delay some shipments. Nutrien and Mosaic are both shuttering mines right now for potash and pulling back on production of fertilizer. I would suggest that they probably won't ramp that production up too quickly until their margins go up significantly, right? They're going to work their way through inventory next year and the year after. So this is another stock, great dividend, oligopoly market, right? There's only about 7 or 8 of these companies out there and only 3 big ones on this continent. A couple more big ones in Europe and Germany and Ukraine. I think this is a pretty good stock to be interested in. Where did my technical chart go? There we go. If you're a value and dividend investor, this is a weird divergence, right? Some of the other stocks, like AT&T, showed that too. Price came down even though money flow started to go up. Could go lower, right? This isn't a sexy stock. This isn't the stock that millennials think about, but this is the type of stock that private equity would be interested in and that big institutions would be interested in taking position because they know that there's really no bankruptcy risk here at all. And there's almost no dividend risk either. In fact, these guys throw out a special dividend here and there. So given that they're in big control of the fertilizer market, they basically control potash by themselves. This is the merger of Agrium and Potash Corp. And they're almost at that, super low support level. 44, 45. This is just a great stock to buy here. There's not a lot of volatility right now in the market in general, which is weird. But you could probably sell puts on this as well. And then Newmont Mining, which I know that some people missed, still one of our best performers this year, up something like 30%, especially when you include option premium. 34, 35. If you get these numbers, I think you probably want to buy Newmont Mining. The theory on the gold miners, of course, is that the massive consolidation in the space has taken 4 big producers that controlled 70 to 80% of the market down to 2. So between Newmont Gold Corp, right, Newmont bought Gold Corp, and Barrick, which bought Rand Gold, they control, 3/4 of the gold market on the planet. So with gold being higher, even if it doesn't go any higher, these guys are very profitable at around $1,000 to $1,100 per ounce. And we've had prices in the 14s up into to 15 recently. I think gold's down to about 13 something right now, but it's still extra money dropping to their bottom lines. So I would expect the gold miners to do very well. One of our picks, let's CDE, you know, just had a nice big rally. I sold some of my calls on this Thursday and Friday. So if you have calls on core mining and you've doubled or tripled your money, I had almost tripled my money. I sold half of my calls. So I'm in it for free now. So if it comes down, nothing lost other than dead money. And if it breaks through and jumps up here to 10, 12, 15, it's a huge gain. So I would keep an eye on core mining. I think it's a buy on pullbacks. Anytime it gets down into the fives again, I think you buy it. 550, 525, $5. You know, look at your support levels, check out your money flow, and you're overbought and oversold. But I definitely think this is a company, that silver tip mine that we talked about starting last year, is a pretty big deal. It's a game changer for them. All right, let's jump into some questions. What's going on with California and oil? Hey, the oil companies, and I've talked about this a bunch of times, and the pipeline companies, they're just not good corporate citizens all the time. You know, the spills, the methane emissions, they're really not following all the rules. And they haven't had to for 3 years because the rules aren't getting enforced. Well, Governor of California said, you know what? I'm going to enforce the rules on you. And that's what's going on there. And this notion that somehow California is in dire straits financially is just pretty wrong. There's some municipalities there that are in bad shape, but you know, the California hate, it's the sixth biggest economy on the planet if it's a country. They got money, right? It's just how they choose to allocate it. Do you recommend buying SunPower January put? Why would I buy puts? I hope you meant sell puts. I think you can sell puts on SunPower. I would not buy puts on SunPower. At some point, I think Fluor is a good investment. I'm not super aggressive on it right now. They've really just gotten their butt kicked. What did we have their bottom fishing at? I think it'd be interesting. What the heck? Where do we have Fluor? Fluor was one of those companies that I trimmed because I didn't think they had a really good short term when I did that trimming of the list several months ago. Yeah, it just kept coming down. Boy, look at that. You're right. That is interesting, huh? Still above book value. Revenue. Yeah. I think this is definitely a company to explore the business. And that, again, is the bottom line on anything. What is their business going to do in the next 5 years, right? Do the numbers now completely reflect sentiment? And if sentiment's negative, but the future is positive, there you go. So your job with Fluor isn't to sit here and look at numbers because they look like they're all coming in the line. The question is to become, is the future for the company brighter than investor sentiment right now? Right? Yeah, I knew what you meant on the puts. All right. But I haven't looked at Fluor's business lately. I don't know who they're selling to, what they're selling. All right, so let's talk about Tesla and Ford. And there's a reason why. I want to talk to you about Ford. I'm adding Ford to the dividend growth list. So I just have the outline so far. If you haven't watched the video for the Ford Mustang Mach-E, you really, I like gold miners, not gold. I think the gold miners is where you want to be. GDX. Actually, I need to put GDX in the global trends because I actually own it. So I'll adjust that. And it actually is a 4 to 5% position for me. So I'll just put that in there, knock it down to 55. I actually, so the Invesco at 10%, right, went up from 5. The gold miners, I think, are very worthwhile. You know, gold miners are one of the few buy the dip areas out there. That and solar. Solar just had a little bit of a correction too. So if you take a look at solar, right, had this real nice rally, then it's come back and it's settling in here. Oversold, money flow. Yeah, somebody pointed out that. I don't know how my charts got all messed up. There you go, money flow, MACD. There you go. This is the way I like to look at it. I think that the solar fund is basically a buy right now. Nibbles, not big bites, but gradually replace any XOP that you have with this, right? Because they're both energy sensitive, and solar has the brighter future. So if you want to own oil stocks, buy the stocks. All right, so Ford and Tesla. There you go. All right, so Tesla had this big break up here. All right, look at that rally. I mentioned in the chat Thursday or Wednesday, right? I don't remember who it was. All right, let me break in one more time here because I'm looking at questions. I'm not a big fan of junior gold miners because they generally have higher expenses. You want to pick the juniors individually, not the fund. That's why we own Core Mining. We were able to spot something different about the company. Something that was of value, the Silvertip mine, which the market didn't give any value to. So ultimately, when you analyze a business, you're looking for assets in the business that the market doesn't appreciate. Silvertip was that asset for Core Mining. Does the whole group of juniors have assets that aren't recognized? I doubt it. And the oligopoly companies are going to control that market and do pretty well with much lower risk. So in general, I don't want to gamble on juniors as a group. I'll pick one out here and there, but I don't want to gamble on the juniors as a group. That's why we don't own a lot in small cap ETFs, right? Because there's a lot of losers in there. Generally, you pick out sectors or industries or throw in some low volatility or dividends, but you don't just want to own all the small caps, just like you don't want to own all the junior miners. You have to be a little bit more choosy there. So some of these slice and dice ETFs or picking out companies is generally the way to go there. All right, let's talk about cars. If you didn't watch the video on the Ford Mach E, and there's 3 or 4 of them on YouTube now, you should watch them. It's a super cool car. And it's going to be priced in the 40s, even when you have it souped up. So if you want a car with 300 miles of range, 311 or something, a little over 300 in range, you're going to spend $40-something thousand for this car. It is super fast, it is super powerful, and some interesting things. The interior of the car is bigger than you'd think. Why? Remember, no exhaust. So it's a flat floor. You can comfortably fit 5 people into this Mustang. The storage is ginormous. Not only do they have a full-size trunk, but in the front, there's a second storage area because they don't need an engine. And it is set up like a giant cooler. So you can fill it with ice and put in drinks. You can put in all your messy stuff from fishing or being outside. And then when you're ready to clean it out, there's a plug in the bottom. You pull the plug and it drains like a cooler, and you can spray it out when it's set up to be sprayed out with a hose. It is, I think, the best crossover vehicle I've seen. So I've added Ford to our list because the valuation is just pretty darn low. And there's people who misunderstand the balance sheet. So that's good for you right now. There's people out there saying, well, they're heavily in debt and they're not going to be able to pay their dividend. You need to understand where the debt comes from. A lot of that debt, right, is balance sheet based on the car loans. So their debt's not as high as you think it is, presuming that most of the car loans get paid off, right? Even if they lose $1 billion or $2 billion, it's not devastating. The company's sitting on $37 billion in cash. Now, they've had a flat dividend for a few years, and they did not pay a special dividend this year, and I don't think that they will. And I don't think that they will next year either. I don't think they're going to have a special dividend for a while. But their dividend rate, if you buy now, is pushing 7%. GM is the company that I think is in trouble here with EVs. What Ford just did with the Mustang and the deal they did with Rivian a while back, I think they're in awfully good shape. So this transition for them looks like it was managed better than at GM. The new labor agreement is very helpful to them, just like it'll help GM. The problem with GM is that I just think they're behind, which is why I think that a merger with them and Tesla still makes a lot of sense, but we'll see. But reducing the models over at Ford, right, getting rid of all the internal combustion engine cars next year, and then bringing out the Ford crossover, I think I'm actually going to buy one. That's how impressed I was. I think I'm going to sign up to get one. I don't know what the down payment is, but it looks like that great of a car. So we'll figure it out. And you've not heard me gush about the car industry, right? I've said that the car industry is going to be tough. I think what Ford just did is really pretty amazing. And I know somebody in Detroit who's has some good things to say about Ford because they know somebody who is very in touch with what the company's operations are. I think Ford is something that you take a look at. If you're a dividend investor, but you want growth as well, and you want to try to find a winner in the car space as they accelerate into the EV future, I think you have to look at Ford. Now, flip side, over at Tesla, I think that Elon Musk has generally been ahead of everybody for a very long time, and I think he's still ahead of everybody. I think the new giga plant in Germany that's going to go in is very smart. I don't know that I would have picked Germany. I would have thought that, I don't know what I would have thought. Maybe Germany does make a ton of sense. It's surrounded by a lot of automotive industry, right? So Germany is one of the centers of automotive industry in the whole world, and it's all within a few hundred miles of each other. So take a look at what they did there. It's a pretty slick move. Somebody actually wrote about it on Seeking Alpha. So if you could find the article on Seeking Alpha where it talks about Musk made a pretty interesting play here in Germany, you should read the article. It's a good article. I think, though, that the stock is ahead of itself. I think that this gap probably gets filled again, right? They'll run into some short-term liquidity issues. Car sales won't ramp up. That pickup truck looks like it needs a lot of work, right? Did you see the video on that? They threw the BB into the window, which is supposed to be almost bulletproof, and it shattered. You know, you know, he said he has to take care of that in production. But I think the Tesla comes back down to the middle 200s. Could it get all the way down here? It could, especially if the market's bad. But I have to look at buying Tesla here because everything they seem to do is ahead of schedule. In reality land, it's behind schedule in fantasy land, and people get mad when fantasy land doesn't happen. But really, they're ahead in the game. They're a loved brand. I think GM's the one that's in trouble, man. I tell you, I think Tesla's going to eat a lot of GM market share. I just don't see the millennials buying GMs. But that Ford Mustang, I tell you what, us Xers and I think boomers, there are a lot of people who are going to like that vehicle. And in fact, the Model Y, right? It's the SUV version of the Model 3. Is that out next year? You know, that's going to be up heads up against the Ford Mustang Mach-E. And I think the Ford's going to give it a good run for its money. I think it's really going to expand the footprint of EVs, the growth rate of EVs starting in a couple of years, especially if the price of oil, as I forecast, goes up a little bit after the election. All right, a couple of questions and we'll call it a day. We have an article on I subscribe to good grief. What's happening with Seeking Alpha? All systems operational. Well, then let me in. See, we have an article on Invesco, so go ahead and read that. Gearheads don't like electric, they'll adapt. Yeah, you know, I don't think people, you know, the purists out there who just want the Mustang to be a gas guzzling sports car, yeah, they'll get over it. Mustang's going to be the main nameplate for Ford in America, right? They're going to have a Mustang sports car. They're going to have a Mustang SUV. They're going to have their trucks. And the trucks are going to start becoming EV in 3-4 years, it looks like. So, yeah. Yep. Ford also has very good driver assist. BRY. These guys? No. Good Lord, man. What if California puts them out of business? They're for sure going to have to cut their dividend, it looks like. You better study this company. I don't even want to put the time into it, but maybe I'm wrong. Yeah, all the all the gene editing companies have gone on huge rallies, right? CRISPR just had a huge rally. NTLA just went from in the 10s to 15, 40%. Let's just look at the last 3 months. I bought it down. I actually bought a little bit of this Intelia. And they all have these funny, I don't have it in front of me, but I don't know. If you go over to NanoString. Was another one of them. They just had a big rally. Not as big as the other ones. But yeah, all these gene editing companies have been rallying. And a lot of that is very future based, right? So we'll see which one of those really are the best. I like Intelia, I like CRISPR. So we just asked about Kohl's. Yeah, I've told you that was coming. See, now it's a stock that's attractive again. Right? What is of value at Kohl's that nobody values? The Amazon relationship and the alternative energy on the roofs. So, I would think that if you're a dividend investor and you want something in the retail space, this is one of the handful of stocks that you take a look at, right? So study the business, find out exactly why the investors, the traders were angry, and see if it's bottoming out. That's a big fat dividend and it ain't going away. My favorites in oil, we've been through this so many times. Occidental, because I think they're positioned for the future. Pioneer, because they're super low debt and they're pure play on the Permian. And Kana and Devon and Parsley. And maybe Parsley is third. I don't know. These guys are a pure play in the Permian. They just did a merger. In general, investors should like mergers. Harold Hamm and some guy from Goldman Sachs were talking about how investors don't know what they want out of the oil space. One day they want buyouts. Another day they don't want buyouts. One day they want mergers. Another day they don't want mergers. One day they want drill baby drill. The next day they're like, oh no, don't spend any money on anything. I'm telling you what, oil investors are just dumb. People who are trying to trade those stocks are stupid. And they're doing a bad job in general. We got blown up by the Trump thing, but they don't understand anything about what they're investing in. And I'll just say that that's pretty pervasive in the market in general. 60 to 80% of people have no idea what they're invested in. I had a buddy text me the other day, why did SunPower drop, and what should I be buying with money now? And I'm like, dude, read. I don't understand any of that stuff. Well, you can't be a good investor if you don't try to understand. Learn about the companies, right? So Procter & Gamble, I have not been looking at the company. I'm not a big fan of staples in general. This dividend would have to be double for me to really be too interested in Procter & Gamble. We know that the international growth story has slowed down. We know that domestically margins are compressing. There's just nothing sexy about it. The activist investor was in there, so you got this big rally. Big rally on a non-sexy company paying a mediocre dividend. Meh. Still high on, book value. This is just going to be a tracker stock. It's It's one of those stocks that you might as well just buy the S&P 500 if this is the type of stock you want. I like AbbVie. I don't know if I love AbbVie. They're another stock that have to be pretty cheap. You know, maybe we should have bought it down here in the 60s. Let's see. Let's see if it keeps falling down. Well, so I'll play with some Elliott Wave on this one. All right. Yeah, Parsley. I think this is a company that's very likely to do another merger or get bought out. If the majors buy companies, I think they're going to buy Permian-focused companies. It doesn't make sense for them to buy anywhere else unless they're just getting add-on, snap-on, little itty-bitty acquisitions, right? Just things to make themselves a little bit more efficient. But Exxon, if you've been watching what's going on with Exxon, you know, I'm going to write this article on Sunday. There's somebody who wrote an article saying, be a little bit more patient with Exxon. I'm going to write an article that says, patience with Exxon will bring pain. Exxon's in just a world of hurt. And folks who don't know that don't want to know that. So, yeah. I think there's a lot of alternatives to lithium. The thing with lithium is that the smaller the battery, the more it has to be lithium. So the battleground there for lithium is whether or not cars in the long term will be as lithium based as they are now. And I'm almost positive the answer is no, right? So that means that lithium is going to eventually get oversupplied if all these new projects come online. Well, one of the lessons of the oil industry, a lot of these frackers just drilled, and they drilled themselves to low prices. We need to see if the lithium producers do the smart thing like Potash did, right? Now Nutrien. They sold their lithium mine, right, when they merged with Agrium. Pretty smart move. Stay in the oligopoly where they control prices. We have to see on lithium, are they going to mine? And what direction technology takes. I think lithium is speculative, even at these prices. But if you wanted to have a little bit of ALB, that's probably the one to have, right? Because they're the big boy. Again, I'm not sure. And I just don't know that we need to reach out for that kind of risk, right? Could it go to 200? It could, but it could also go down to 20. I don't feel that. I don't want these giant downsides. Manage risk, and the return will take care of itself if your ideas are solid. VIX. Okay, let's finish with VIX. So what we know is that the this is actually what I want. We know, right? VIX is in that, got a 12 handle now. We know that every time it gets down here, it bounces. And it seems like the floor has been a little bit higher since the start of 2018 when I set the record lows. I still own my VXX position. I hate that it's deteriorating on me. If we don't get the Thanksgiving hiccup, then I'm going to exit one way or another in the next couple of weeks. How's that? So one way or another, I think you have to get out, whether it starts to go like this or whether it goes like that. Unless there's something amazing that happens that really shakes up the markets. Like, I don't know, pick your poison. War, impeachment, company, bank goes under. I don't know. You know, we know there's a couple banks in trouble, Deutsche Bank, Santander. So we'll see. But to avoid the deterioration of VIX, you can't stay in it much longer. You have to find a reset. Why doesn't it want me to do that? Oh, I did it backwards. Wow. I don't know why the two search boxes at Y charts don't work the same. Right? Just deteriorates even when there's a bump in volatility. Can't hold this long. So I'll be out of this in the next week or two. All right, let's finish there. Let's see. Let's see what happens. Have a great weekend. I am going to do a show on Black Friday. If I can think of something fun to do, I will. Yeah, keep an eye on, your pumpkin pie, your turkey, whatever it is you're eating. We're in charge of potatoes this year, so went to Costco, bought I don't know, I think it was like a 75-pound bag of potatoes. I don't know, it's a big freaking bag of potatoes. So I'm going to be making some potato casseroles, put it in the freezer, a bunch of mashed potatoes for Thursday. You know how that is. In any case, have a great weekend, and I'll get this up by tomorrow morning at the latest, but I think probably this afternoon because I'm working. All right, take care.